If you're planning to sell your business or have sold your business, let me show you how you can pay absolutely zero tax and pocket all the profits. This is completely legal and the ATO actually encourages you to do this. What's up, tax fam? Understanding capital gains tax and how it's calculated on the sale of your business is super useful. So in this video, I'm going to talk about small business Cgt concessions and how you could possibly pay zero tax when you sell your business. Yeah, you heard it right. Zero tax. First things first, let's chat about capital gains tax, or CGT. Basically, that's the tax that you pay when you sell an asset like a house or a business or a portfolio of shares and you make a gain. For example, if you buy a house for $500,000 and you sell it for $600K, that means you've made a capital gain of $100,000. When you make a capital gain, the profits are then added to your taxable income and you will increase the tax you need to pay when you lodge your tax return. And if you make a capital loss, it will be offset on future capital gains. But CGT isn't all doom and gloom. If you know how to take advantage of the tax concessions, it could benefit you immensely. Now let's look at how CGT works on the sale of a business. For small business owners who are looking to sell their business or sell the assets used in the business, such as a shop or a factory, accessing one or more of these concessions can significantly reduce your capital gains tax liability. Also, the profit on the sale of your business could be disregarded, reducing your taxes to zero. The amount of CGT you pay depends on how you can use the concessions effectively for your situation. For example, Leon started his business himself, has grown his business so he now earns a profit of $200,000 a year. He's taxed at the 45% tax rate. When he sells his business, the capital gain will be added to his personal income and the capital gain will be taxed at 45%. Note, if he held the business for more than 12 months, he can get a 50% discount on his gains using the 12-month discount capital gains rule. To qualify for the small business CGT concession, you will need to meet the set of conditions imposed by the ATO. You may qualify for one or more of these small business CGT concessions if you meet the following steps. Number 1, your small business turns over less than $2 million each year, or the total value of your net assets and related entities doesn't exceed $6 million. Number 2, the asset being sold is an active asset. In other words, the asset's being used for the business purpose. The ATO suggests considering the following pointers to determine if your asset is an active asset or not. The active asset test is satisfied if the asset was an active asset of yours for a total of at least 7.5 years the asset was used for the business, if you own it for more than 15 years, or for at least half the ownership period it was used for business if you've owned it for 15 years or less. For example, the commercial property of where your business operates will be considered an active asset if you've used it for business for more than half of the time you've owned it. There are 4 possible concessions that could be eligible when you sell your business. The first one is the 15-year exemption. This is definitely the most generous of the 4 small business CGT concessions because the entire capital gain may be exempt from tax. According to the ATO, to qualify for the 15-year exemption, you must have continuously owned the asset for a period of 15 years or more just before the sale of that asset. If you're an individual, you also have to meet the following conditions when the sale of the asset occurs. You must be at least 55 years old and the sale of the asset occurred because you decided to retire or you were permanently incapacitated. Let's have a look at the example. Jonathan bought a factory in Sydney, New South Wales, and he's owned the factory and used it for business since he bought it in 1995. Jonathan is turning 65 years old this year and he's looking to retire. But because his children have all successfully built their careers in the corporate world, he decides to sell the factory. He purchased it for $1 million and now sold it for $2.5 million. Jonathan made a capital gain of $1.5 million for the sale of the factory, has owned the land for more than 15 years straight, and he is above the age of 55 years old. So he qualifies for the small business CGT 15-year exemption as long as he meets those other tests. The capital gain is set aside and Jonathan won't need to pay capital gains tax on the sale of the factory. The second concession is the 50% active asset reduction. So let's have a look at Nicholas's example. Nicholas owns a small commercial property in which he used to run his business. In 2020, he decided to sell the property to start a new business venture. He made a capital gain of $19,000 on the sale of his business property. Nicholas purchased the property in 2016. As he had owned the property for more than 12 months, when he sold it, he qualifies for the 50% CGT discount. That's $19,000 times 50% equals $9,500. But he also qualifies for the 50% active asset reduction because he meets the ATO's basic conditions. His business turns over less than $2 million each year and his asset being sold is an active asset. In other words, it was used for the business purposes. So he's only liable to pay CGT on $4,750. Assume that his tax rate is 37%, he will only need to pay $1,757.50. That means he only paid less than 10% tax on the overall capital gain. Simple as that. Next, we have the retirement exemption. According to the retirement exemption, you won't have to pay CGT on your assets up to a lifetime limit of $500K. The retirement exemption can be used with or instead of the 50% active asset reduction. If you decide to retire early, in other words, you retire under 55 years old and have chosen to use the retirement exemption, you'll have to pay the exempt amount into a complying superannuation fund or retirement savings. So let's use an example. Lily, who is a fruit farmer, has been running her business for at least 20 years, has decided to retire early, sell her farm so that she can go live on the coast with her new grandchildren. She's only 53 years old. Lily made $1 million capital gain from the sale of her farm. She purchased it for $200,000 and sold it for $1.2 million. She doesn't meet the requirements for a 15-year exemption, so she applies for the retirement exemption instead. She meets the basic conditions for a small business CGT concession, as well as the requirements for the retirement exemption, so she can set aside the entire capital gain. But because she's under 55, she has to contribute the limit of $500,000 capital gain to her superannuation fund. If she wants to reduce the amount of money that goes into her super, Lily can choose to use the 50% active asset reduction and 50% 12-month discount to reduce the net capital gain and roll over a small amount to the superannuation fund. This means she pays absolutely zero tax from the sale of her farm. So this sounds confusing, so let's do the maths. $1 million capital gain, 12-month 50% discount reduces it to $500K. 50% active asset reduces it to $250K. Contributed $250,000 to super, you're left with zero capital gains, which means you've paid zero tax for that $1 million gain. And the best part of it is that it's 100% legal. People might say to me that they have had to contribute $250,000 into super, but for your information, superannuation tax rate is taxed at 15%, and when you retire, it's at 0%. Most business owners will prefer that their future income that they make on that $250K they've contributed into super is either taxed at 15% or taxed at 0% when they retire. Now, what is the replacement asset rollover? That brings me to the last small business CGT concession. According to the rollover concession, if you sell a business asset, you can elect to roll over the money that you receive from that to buy another asset. And you've got up to 2 years to do that. So if you've received $1 million from the sale of a business, you can apply the 50% general discount, then apply the 50% asset reduction, so you're left with $250 capital gain. You can then buy a $250,000 replacement asset, but it must be an asset that's related to a business. And you need to buy this within 2 years. And as a result, you pay no tax. Keep in mind, this video is to provide general information, so you want to consider getting personalized advice from an accountant before planning or going through any big transactions like this. You can make millions of dollars and pay zero tax, but if you get it wrong, you're probably going to pay millions of dollars of taxes. So, if you like this video, don't forget to like and subscribe to our channel, and I hope that was very helpful for you guys. If you've seen someone that might need this video or might need further information regarding this, please send them the video for them to watch. See you guys next time.